I think this move from 2000 to 3400, that's your move. Like that move happened in advance of the expansion that we'll see in Washington. And now we chop and flop through this little zone for a while. I would be stunned if in the short term this keeps going to 4,000 or something. I would be surprised this year. I would be surprised if there's more. I think that this, if you think about it, all this big, beautiful bill, all these things, all these trillions, this all is happening now after the move in gold. All this stuff that you were reading before from that Bloomberg, excellently written Bloomberg article, the all this stuff, gold moved before all these things happen, if you notice. So I think gold sniffs these things out and it moved.
Bullion climbed 0.5% to approximately $3,340 an ounce as markets reacted to the president's comments and the administration prepared to send official notices outlining the new levy rates. EBTucker, editor of the Tucker letter, cautions investors not to expect immediate continued upside in gold. According to him, much of the recent price action reflects anticipation of future policy rather than current developments, while gold remains supported by ongoing U.S. fiscal deficit concerns, amplified by the passage of Trump's big, beautiful tax and spending megabill in the House. Tucker believes the next phase may be a period of consolidation. Now, gold may consolidate in a range. Dramatic gains like $4,000 gold are unlikely this year, he says. Still, Tucker sees value in starting a position for those who are underexposed, warning that chasing short-term momentum may be too late. Meanwhile, the July 2025 report from the Shanghai metal market highlights a narrowing spread between spot and futures silver prices. This convergence signals an evolving market dynamic that carries meaningful implications for both traders and industrial users. Expectations of a September 2025 Federal Reserve rate cut have created a broadly supportive environment for precious metals, despite uneven physical demand for silver. While Tucker personally holds a significant amount of silver and believes it could eventually reach $50 per ounce, he remains cautious about adding more. Silver is bulky and hard to store, and acquiring large amounts is inconvenient, he says, noting that the current enthusiasm among silver investors feels overstated. In his view, many other assets could deliver similar returns without the logistical hurdles. Make sure to tune in for our expert analysis. Don't miss out on future content. Hit the subscribe button and turn on notifications to stay in the loop. Your support is greatly appreciated.
Gold, what most people don't understand about gold, I don't know if they didn't read my first book or they can't understand, is that gold usually moves before the event that people think would make it move. You know, for example, gold hit over 1,000 in March of 2008, 5 months before September of 2008 happened, right? So you go back to 2019, this was the case. Pre-COVID, it moved $200. All these things, you know, these were big numbers back then, by the way. Now it's like 3,400 or something. I think this move, this 60% move really is what it is preceding what's coming out of Washington. And what's coming out of Washington is 2 rate cuts to normalize the yield curve and incentivize development, building, and investment and spending to keep this system growing. And gold sniffed that out. That's why Powell is out. That's why whoever goes in will do 2 rate cuts. We're going to show the chart of the yield curve tomorrow. You'll see that there's a reason they want 2 cuts. They're going to get 2 cuts, not 4 cuts, not listening to the market. You know, the Fed does not listen to the market. It manages the U.S. economy. People got to get that through their head. This is not people studying, trying to help. Okay, this is trying to make sure the system gets bigger but doesn't explode. That's what they're trying to do. Now, will they be successful? I don't know. I mean, eventually, it seems like probably it explodes. But I don't think it explodes for a while. I mean, I think you should play their game for a little while. Like, fighting that game has been a painful exercise for people that try to do it. I think we grind in a pretty boring range now. I think this move from 2000 to 3,400, that's your move. Like that move happened in advance of the expansion that we'll see in Washington. And now we chop and flop through this little zone for a while. I would be stunned if in the short term this keeps going to 4,000 or something. I would be surprised this year. I would be surprised if there's more. I think that this, if you think about it, all this big, beautiful bill, all these things, all these trillions, this all is happening now after the move in gold. All this stuff that you were reading before from that Bloomberg, excellently written Bloomberg article, all this stuff, gold moved before all these things happen, if you notice. So I think gold sniffs these things out and it moves. And that being said, you know, like if you have zero gold, obviously, you know, it's always a good time to fix that. But you know, if you're trying to play it for a move, I think you missed the big part of the move. it's that, and that's just me. I mean, I look at silver, people are like, is it going to go 50? Probably, but like, who really cares? I mean, like, it's the silver coin premium is so high that it's like, it's hard to get material amounts of silver. And then people say, what are the silver mining stocks? I mean, fine, there's a few of them, but there's not that many of them. And the gold mining stocks, they really didn't move. If you think about it, if you 10 years ago, I knew you back then, if you 10 years ago asked people at the gold conferences, what would $3,400 gold do to your business? They would have told you that, sky's the limit, right? But the gold stocks haven't really moved. I mean, so what if they've had, I mean, we own, two of them in the Tucker letter, but that's all we own. We own, physical gold as well. But the thing is that the move that they made is not what any of those people would have told you would happen with gold moving, to $3,400, like 60+% in a year. They would have told you that mining stocks give you leverage to go higher. It didn't work. So my point is, when you sit halfway through the year, it's a great time to think back on the year and say, what worked, what didn't work. Like, stop doing what didn't work and start doing what did work. And I would say, like, for myself, I'm glad I own gold. I'm glad I'm not like monkeying around with gold dealers. I'm going to mention Thursday that there's been some really strange behavior in the gold dealer market. I mean, like, there's plenty of gold available. Like, some of the dealers have become quite shady. It's complicated. I'm just glad to not mess around with that. I'm glad I was
give
paying
us more details now?
in the newsletter. Yeah, I think you want to be delicate about that because we don't want to but I'm going to talk about transactions that I've made that I've been surprised. I've been surprised of how they were handled. And I'm just glad that I was paying, 150 basis points on, Gold Eagle when gold was $500 and not 3,400. That's how I feel about gold. I mean, I think that, like, it's sensible to have some gold and to have some Bitcoin. When it comes to silver, I'm not really sure. I mean, I have a lot of silver. I'm not really sure I'd buy it again. And I also don't really understand why the silver people are so enthusiastic. Yes, I think it'll go to $50. Like, yes, I think $36.17 is too cheap, but it's also, like, incredibly difficult to store. It's really hard to get a hold of it. And, like, if something's going to move 50%, I think a lot of things can move 50%, and you don't have to like install, a vault in your guest room to store all the stuff. In my first book, which I think is a pretty, for somebody that has no idea what's going on in the gold market, is pretty good, is that, like, I actually do like both. I mean, the thing is that your physical gold is a lot harder to sell. So you're probably not going to sell that. But the paper gold is easy to sell. So the paper gold is, like, seamless. You're in, you're out, you do whatever you want. And so there is some logic to having that as a trade. That's something that I do. If I want to take a gold position, I'm not, like, calling up one of these shady dealers that, takes forever to send me the gold, sits in my cash for, 12 weeks, and then doing the same, when it's time to sell it, right? I mean, like, I can easily I have opinions about the ETFs. I mean, I think it's kind of personal preference, but there are some of them that are pretty liquid and pretty easy. And I think that's a nice thing to do, whereas with silver, it's like, look, it's an industrial metal. Look, it's fine to have it. I have it. I just don't know that I would load up on it again. I don't know if waiting 15 years for a 50% move is really something that excites me that much.
Tucker challenges the widely held belief that rising gold prices automatically lead to outsized gains in mining stocks due to their operational leverage. He argues that, despite gold's strong performance, mining stocks have not always followed suit. Gold has been on a powerful run in 2025, hitting multiple new highs and gaining more than 25% year-to-date. Analysts at Goldman Sachs believe the metal could reach as high as $3,700 before the end of the year. Against this backdrop, investor interest in gold equities remains strong. RBC Capital Markets notes continued enthusiasm for gold mining stocks, even if their performance hasn't always matched expectations. The VanEck Gold Miners ETF has surged 45% so far in 2025, reflecting robust investor appetite. Analysts suggest that any pullbacks in these stocks could offer compelling entry points over the coming quarters. With gold spot prices soaring and valuations of mining companies still low by historical standards, many see these equities as offering attractive risk-reward opportunities moving forward. Let's get back to the interview.
Generally, nobody in that business wanted any of my advice and continued doing the same thing that enriched them prior, and their stock prices have done about what you would expect. Now, this is not all the companies. Obviously, there are some executives, mostly in Toronto, less so in Vancouver, that have decided they're going to run, profitable and responsible gold companies, and the stock prices have done okay. I just think you could have done a lot better having like much more liquid, like much easier to understand, much stronger trending stocks in the US. And you start comparing like the ease of buying, even the best gold miners with buying, like other stocks that we don't really get into details, but like there's lots of stocks in the US that have done fantastic. Their sales and their businesses have exploded. They've been story stocks. They've been plenty liquid. They've gone bananas, and you could have bought any of them. You could have almost bought like half a dozen of them and been successful with all of them. And you look at the gold market and you're just like, why would you own this? Like, I mean, the fact is in 2020, they had a move, okay? And they didn't really hold on to that move. And they have not really been shareholder friendly over the long term. And every time I say this, I get a nasty note from like one of the better CEOs that says, we've produced 15% annual returns. And I'm like, that's fine. I mean, like, I'm not going to name names, but like big liquid US tech stocks have produced, 50% annual returns over the same time. And they haven't been like digging around in, the middle of Africa and stuff and like having lots of risk, like that it's the business is broken. It's totally broken. And I don't think it's going to get fixed anytime soon because I don't see any viable solutions that really adequately reward the shareholder. The other thing is most of the people involved make way too much money. There's too many companies. There's too many like crooked deals from rubber stamp boards that reward these executives if there's any sort of, change of control event. And the result is the stocks don't go up, David. That's the result. Like, what do we really care about here? We care about buying stocks that go higher. And many of those stocks don't go materially higher. And don't even send me an EBTucker.com, comment that's like naming one stock that went up decently or something like that. Because the fact is that, most of those companies spent 15 years paying themselves excessive amounts of money, damaging their capital structure, and gold during that time went up a lot. Does this make sense? This is the thing I think people can't see. I mean, like AI comes in and gets big, AI companies get bigger. Gold gets big, gold companies get smaller. I mean, it's like, what's that about? Like as a shareholder, don't even worry about it. You're just like, I'm going to buy stuff that's going up. I'm not going to buy stuff that's going down thinking that it's going to turn around. I mean, the trend is what you want to buy. Stuff's going up, keeps going up. Stuff's going down, keeps going down. So like, it doesn't really take an advanced math degree.
The good miners, what are they doing that the miners
are there
bleeding
any good,
money are not doing?
We have two of them, and we bought them because of the chart. That's why we bought them. So like the thing is that we didn't really, I think they're well run, but we bought the chart. That's what we did. We looked at the chart and we said, you know what? Charts are something you can trust because when you see chart action that's, moving up, that's what you want to buy. When you see chart action that's moving down, that's what you want to sell. And I think the deal is that they've been ultra disciplined and like they're making money. I think that's what the deal is. They pay a dividend, they make money. They haven't gone out and bought bizarre stuff. They haven't bought excessively speculative stuff. But you got to remember something, David. These companies are debt free. I mean, imagine in a world with $300+ trillion of debt, you're talking about an industry that's not allowed to borrow any money. I mean, largely speaking, it's a debt-free industry. What does that tell you? It's like nobody's loaning these people money. So if you're a shareholder, be careful. Like you're going to buy a stock that's going down that the company can't sell bonds. What's that about? I mean, it's just crazy. Doesn't make any sense. It makes you wonder, why do people even like it to begin with? They like it because there was this old idea from prior markets that if gold goes up, stocks go up more. They have operating leverage. It didn't work, David. Didn't work. And that's what people need to see. It didn't work. So you want to buy things that work and you want to not buy things that don't work. I'm not sure I can get down with the whole asset parity thing of the two things. I think that's a little bit of a stretch, and also considering like that's a tenth right now. I mean, it's like an eighth or something of the, because the gold's like I haven't run the numbers, but I think it's like 22 trillion or something like that, maybe 23. But the thing is, I'm not sure that I'm making that bet that there's going to be parity. I think a much more logical bet, and let's just be very hypothetical here, is let's just say you had like 6% of your assets in gold and you had 3% of your assets in Bitcoin. I think the 3% might become 6%. Then you might have some sort of like parity, and the Bitcoin people are so aggressive towards me when I say that, because they're like 3%, you need 100%. And I'm like, what's the point of that? I mean, it's like, it doesn't make any sense to me. I mean, I met those Winklevoss twins there, talked to those guys. I mean, that was weird. One of them has like a blinking disorder, so it's very difficult to take a picture with them. But, they're giving away an orange Cybertruck and this DJ with like a moon suit on and stuff. It's totally crazy. I highly recommend people go to the Bitcoin conference. I've never seen anything like it. I mean, the gold conference, what you got to do is go to a gold conference. It's a sad state of affairs. Really sad. It's very small. Like, they've closed off most of the conference. It's quiet. It's somber. Maybe they have like a minimal amount of entertainment for you. Definitely not going to have an open bar. None of this stuff. Then go to the Bitcoin conference. It's hard to find the conference because there's DJs and dancers and live bands and a spaceship. There was a Formula One car. You could change the tire on it. There was people on the ceiling. There was Steak and Shake people dressed as cows walking around. It was crazy. There was a punching bag competition, a guy with a chicken suit on. I've never seen anything like
that. Signal
it would be the top if I was hearing people say at the Racket Club how much they were buying Bitcoin with all their assets. And I don't hear them saying that. I hear them saying that they're talking about stocks. That's all they're talking about, stocks. Can't even get on the court without having to answer a stock question. It's very annoying. I don't hear them saying, I just got all my money in the Bitcoin. I think this Bitcoin crowd can get bigger. That's what I think. I think it can get bigger. I think it will get bigger.
Gold mining stocks have historically exhibited amplified reactions to movements in the gold price, typically rising or falling at 2 to 3 times the rate of the metal itself. This leverage effect cuts both ways. While rallies in gold often lead to outsized gains in mining stocks, declines can result in even sharper losses for the sector. This amplification stems from the operational structure of mining companies. Their costs of extraction and production are relatively fixed, so any increase in the gold price translates directly into higher profit margins. For example, a 10% rise in gold prices can potentially boost profits by 30% or more, depending on the company's specific cost base, efficiency, and financial leverage. Conversely, when gold prices fall, those same margins contract quickly, exposing the downside risk inherent in these equities. Not every precious metals rally tells the same story, and this year's surge in gold may be rewriting the rules for miners and investors alike. While spot prices soar, the behavior of mining equities suggests that confidence in operational leverage is more fragile than once assumed. Add to that the logistical limits of silver ownership and a cooling-off period in gold's trajectory, and it's clear the market is shifting from euphoria to recalibration. For those looking to build long-term positions, timing and structure, not just price, could be the most valuable assets of all. Is the current phase in gold and silver a pause before another breakout, or a reality check for overextended expectations? Share your perspective in the comments section. If the video resonates with you, join our community by subscribing to our channel and enabling notifications with the bell icon. Thank you for being a part of our community.